So let's call the 2023 stock market an interesting one. It's been quite a roller coaster year. From where we started, we saw the market really rise dramatically through, say, late July. And then it kind of came crashing back to earth when we realized that inflation looks harder to control than the Fed originally thought. And interest rates might stay higher longer. And now the S&P 500, it dipped into correction territory, meaning 10% off of recent highs. So we are going to look at some stocks that we like in the market right now. Before we get into it, please take a minute and check the link you see on your screen. You can get the top 10 stocks to buy right now from our sponsor, The Motley Fool, and it's the best way to support this work that Tyler and I are doing on YouTube. So we're going to each look at one stock that we think is very cheap right now and one stock that we each think is a great high yield play. It's not necessarily cheap, but a great high yield stock to look at. So I'm going to talk about a stock that I haven't talked about in a long time. It's an insurance company called Lemonade. Ticker symbol is LMND. I can already see Tyler grinning at me about it. Lemonade is about 93% off of its all-time high. To be fair, it should never have been trading that high. This was in the late 2020, early 2021 market, like euphoria with growth stocks. It did manage to raise a lot of capital at that high level, which was kind of the thing that saved it in the downturn. Lemonade recently reported its earnings, and things look really impressive, not just from a current standpoint, but from a future profitability standpoint. For one thing, the reason I call it cheap is Lemonade, even after today's or the post earnings rally, trades for a market cap of about $880 million. It has $945 million of cash on its balance sheet. Its business is actually being given a negative valuation. To be fair, given recent performance, that might make sense. It's been losing money very, rapidly for some time now. And the company said it would be able to become profitable without burning through all of its cash, but investors really didn't see it. So in the third quarter, Lemonade reported pretty strong growth, 18% year-over-year growth in the premiums it has in force. That's pretty good considering that Lemonade is prioritizing profitability over growth and really slowing down growth, as management said. Its loss ratio is still not where it needs to be. The company is targeting a 75% loss ratio, meaning the percentage of premiums it's paying out for claims. It's at 83% now, which is still too high, but is 11 percentage points better than the disastrous numbers we saw a year ago. So numbers are looking good. The company has burned through $103 million of cash in the first 3 quarters of the year, which sounds like a lot, but remember there are $945 million still remaining, so that's a lot of runway. And the thing that really stood out to investors and why the stock is up about 20% after earnings is Lemonade says that it will be able to achieve positive free cash flow by the end of 2025, quote, with hundreds of millions of dollars of unrestricted cash still on its balance sheet. That's much sooner than management had previously said and much better than most investors thought it would hit. And it will achieve EBITDA profitability very shortly thereafter. Because of the nature of the insurance business, you get premiums and then you actually get to claim it as earnings. There's a bit of a lag, so it sees adjusted EBITDA profitability by early 2026. This is the first time it's given like clear dates for that, and it's sooner than everyone expected. If it can achieve those goals, which to be fair, a lot still needs to go right for it to get there. It needs to get its underwriting under control. That loss ratio needs to get under 75%, which its recent cohorts of customers, that looks like it's going to be the case. If it can actually get there, this could be a home run for investors. It's a very cheap stock. It is cheap for a reason, but it's one that after this earnings report, I think deserves a second look. Tyler?
Yeah, so I've been intrigued lately by hospitality. So basically like hotel REITs. It is a part of we'll call it like experiential real estate a little bit, but it's one section of the market where things look peculiarly cheap. And I'm going to use one example here, and it's Summit Hotel Properties. What I, in terms of like, if you look at the portfolio, we had the awful times of COVID, so they suspended dividend and debt looked pretty precarious there for a little while, but they were able to work their way through it. And now, like for example, total debt to EBITDA is a little bit higher in the last 12 months at about 6.3 times compared to what it was pre-pandemic. So it's a little bit higher, but not so egregious that I think it necessarily would scare off investors. And for Summit Hotel Properties, it partners with relatively good operators. So Courtyard Marriott, Hyatt, Hampton Inn, a lot of very name brand properties, has a lot of exposure to what we would call the Sun Belt, Southern United States, kind of the sunny destination areas that have been much more popular as of late. But right now, Summit Hotel Properties is trading for 0.6 times its book value. So basically, the market is saying that the book value of the assets on its books are worth considerably less than what the balance sheet says. And either the market is viewing this as like, look, we are about to hit a recession, discretionary spending is about to fall through the floor, and we're going to see some large write-downs from a company like Summit when they go to refinance. That may be true. I'm not 100% sold on that idea, but what is surprising to me is that a lot, Summit Hotel, hospitality REITs in general, are trading for discounts to their book value similar to office REITs. And if you were to tell me right now, like who is going to perform better over the next 5 years, hotel REITs or office REITs, I would say hotel in a heartbeat, because I think that there are structural challenges at office REITs versus hotels. It's just kind of the economic cycles of owning and operating hotels. Not great sometimes, but overall, it's going to work out in the long run, I think, especially with companies that are associated with good operators, like I mentioned. And so if I'm looking for something really cheap in the real estate sector right now that doesn't scare the pants off of me, like, office REITs, for example, I'm going to start looking harder into these hotel and experiential REITs because they are trading at more or less the same kind of discounts as office REITs with, I think, better opportunities on the upside.
Okay, so those are our two cheapo stocks that we're looking at right now. I'm going to quickly go through a couple of high yield ones that we like right now. One that I didn't expect to like as much until I dug into it about a week ago is Rowe Price, the investment management company. TROW is the ticker symbol there. And the stock is dramatically underperforming the S&P over the past year. It's down about 14% year over year, whereas the S&P is up about 9%. So its earnings looked okay. The big thing going on with Rowe Price is that, like many mutual fund issuers and things like that, it's seeing a lot of outflows right now. T. Rowe Price has about $1.3 trillion of assets under management. That's down $53 billion year over year, sequentially. It's a pretty big dip from the second quarter. And some of that is because, as I mentioned earlier in this video, the stock market hasn't been doing very well in the past couple of months. So a lot of that is just declining asset values. But $17 billion of that is net outflows, meaning that people are taking money out of T. Rowe Price accounts faster than it's flowing in, which that's net outflows. So some money is still flowing in from like 401ks and retirement plans and things like that. The reason for that primarily is that interest rates are staying much higher than expected for longer, and you can get risk-free investments a lot more attractive than they used to be. So if you invest in a T. Rowe Price mutual fund, think of it this way. What's the best you can expect to do over the long term? 10% annual returns, 11, maybe 12. If you can get 6% from a 1-year CD, is that as attractive as when CDs were paying like 1%? So, risk-free investments are just so much more attractive right now. So you're seeing a lot of people pull their money out in favor of those. Again, I think that's a temporary headwind that we'll see reverse if and when interest rates start to moderate. But it's looking like interest rates could stay higher than anyone really thought, except maybe Tyler. He knew that that was going to happen. But
No, I didn't know that was going to happen, but there's only so many places you can go from zero.
that's true. But it looks like interest rates are going to stay higher for longer, so this could be a more persistent problem than we thought for T. Rowe Price, which is what we're seeing reflected in the stock price. But it has a 5.5% dividend yield, which I never thought I would see from T. Rowe Price. And it is one of the leaders in what it does. And long term, this is a very solid, well run business that has a very established track record of delivering returns for investors.
I've had this question about actively managed for a little while, like T. Rowe Price is with actively managed funds. We've seen basically like a decade and a half of investor outflows, and basically all of the money that's been gained from active managed T. Rowe Price, all of the others, has been from stock market gains because the outflows are going into passive index funds and ETFs and things like that. So there's part of me that wonders, like, is a T. Rowe Price almost like a cigar butt kind of stock? You know what I mean? Like, it's a managed decline over a really long time, not too dissimilar from like tobacco stocks where it's like, yeah, the total volume's going down, but we're able to make it up because of, we're getting good returns. So that's just my 2 cents on active management companies like T. Rowe Price. But so if I'm looking for a high yield right now, I think I've mentioned this one before in other places and maybe with you before, Matt, but I'm going to go with Easterly Government Properties. They are the landlord to the US government. Most of their properties are FBI field offices. They have some stuff with the DOJ, Treasury, things like that. If you're talking about a tenant, is there really a better high quality tenant than the US government? They own their own money printer. They have a military. They can kind of do what they want when they need to pay their rent. And in terms of like how things are going to play out over time, you're much less likely to see the US government make drastic changes quickly. Like they're not going to shut down an FBI field office in Atlanta, Georgia at the drop of a hat because of, rates of, returns aren't great or the economy isn't doing so hot. It's a very reliable tenant. It's likely going to be there for a long time. To be fair, they're not going to be a fast growing tenant, and the terms on leases are not going to be like, you're not going to see 10% annual growth from your leases. It's going to be at maybe even slightly below inflation. But all of that considered, Easterly Government Properties right now has a dividend yield of 10%. It is, I would say, not the most secure. It's like, I think their payout ratio based on cash flows is about 90%. But again, there's not a lot of downside to leasing out to the US government. There might be some refinancing of debt, but all things considered, at a 10% yield right now, I think that even if we were basically, they were saying, look, we're just going to keep our dividend flat for the next 5 years, I think that type of yield is high enough to reward investors for owning a business, having the equity side, not being involved in any debt. That is the kind of like equity dividend return that I would want to justify paying more than say, like, I don't know, like you said, buying 1 year treasuries or having a 1 year CD or something like that. So if I'm just, that to me is the kind of risk reward balance that I would want for my dividend high yield company right now.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.